how high do you think rates could go here? Will they go as high as the Fed is guiding us towards? A lot of people think, no way, the Fed is just talking a big game here. It's going to pivot long before. It can't stand, the pain that it's causing here. But there are other voices saying, no, I think the Fed's going to tighten a lot longer than most people expect. What do you think?
I think there's no way they tighten very much longer. And a reason I think that is the factors that most in the mainstream still aren't watching, which is the U.S. balance sheet and really the U.S. income statement, the deficit as a percent of GDP. And when you look at those numbers, the debt to GDP, they are what they are. They're too high. That can go on for a period of time. But really, the issue is the income statement, right? So the U.S. is spending 70% of tax receipts roughly on entitlement pay-goes. So that's Social Security Administration, Health and Human Services. They're spending another, call it 25% of tax receipts on Treasury spending, which is interest and some of the stimulus, et cetera. That number, in fairness, could come down post-COVID. We'll see. It has come down a little bit, but it's running at $1 trillion, roughly $1 trillion annual rate still. Defense is another $800 billion. I don't think that number's coming down given what's going on in Russia and elsewhere around the world. So when you add those three up, those what I call the big three U.S. government expenditures are about 110, 115% of tax receipts. And here's the critical part. Tax receipts are at all-time record highs. If you graphed them, they look just like all these bubble assets, except they haven't rolled over and crashed yet. But we've been highlighting a chart to our clients showing the year-over-year change in federal tax receipts against the year-over-year change in U.S. equity market cap and against the S&P 500. Tax receipts are very, very likely going to fall sharply in the United States over the next 3 to 6 months. And if/when they do, the U.S. government is going to have to issue more treasuries into a treasury market that is already quite unsettled, as we've seen. It's already dysfunctioning. Mortgage market's already dysfunctioning. You've already seen the mortgage market 2 Fridays ago go no bid for a period of time. And at that point, I think the Fed is happy to keep tightening until they break the U.S. government. I don't think they're going to break the U.S. government. I think they're going to have to come back in, pivot, loosen, resume QE. I think eventually, I don't think that will be their first move. But I think it has been one of the more fascinating dichotomies in my career. I've been doing this 27 years, and it has been this complete ignorance of the elephant in the room, which is the U.S. fiscal and debt situation. We keep hearing all these policymakers come on and talk about the Volcker playbook, like debt to GDP was 120% in 79. It wasn't. It was 25 to 30%. Like deficits were 6-7% of GDP. They weren't. They were 1.5 to 2. So that Volcker could put the U.S. economy in a recession. Oh, by the way, is a much less highly financialized economy, younger economy. Payments were way lower. It was just an entirely different animal, and yet consensus to me, or it's certainly a big part of consensus, seems to be, well, don't worry, the Fed can show their inflation credentials again, put the economy into a recession, and it'll be just like Volcker. It's not going to be just like Volcker, because if they put the economy in a recession, the last 4 recessions saw debt to GDP, deficits as a percent of GDP rise by 1,000 basis points in the COVID crisis, which I think is a special case. Throw that up. 800 basis points, 500 basis points, 300 basis points, 3 prior recessions to that. So let's just take the middle case, 500 basis points. You're talking about 500 basis points on a $22 trillion economy that has $1.1 trillion in extra treasury issuance, basically immediately over the next short run that would have to be issued as receipts fall and as countercyclical payments rise in a recession, unless the Fed came back in with sizable QE. Because, oh, by the way, the Fed's supposed to be selling treasuries alongside that increase in treasury issuance. The U.S. is still going to be running $1.2 trillion deficit. And foreigners, with the dollar where it is, I don't know if people saw the TIC report last week, they're selling treasuries. The Japanese are selling treasury. The dollar's too strong. So who's the buyer? And the answer is it's either the Fed, if they don't want rates to rise or in a recession, or if they want to let rates rise in a recession, like they do in an emerging market economy with the balance of payments problems, then that's what the U.S. is going to have. If the Fed stands aside, we're going to see a recession with rates flat to up, treasury rates flat to up in the United States, which, when we're this indebted, is not very good for a recession. So to me, that's the Fed's worst nightmare. I don't think they want to get to that point where you have a recession with rates rising. I think there is very little chance. I think we've been saying that they're going to be done. They're going to have to pivot by the end of 3Q. We've been saying that for, I think, a couple of months now. And after the last 2 weeks, I would take way under on the end of 3Q22 when the Fed starts to pivot, whether that's a pause, whether that's, well, however that looks, that pivot looks. But there's just what you're seeing in the credit markets, whether you look at the treasury market, the mortgage market, the high yield market, foreign sovereign markets, the Bank of Japan, European, they're all having the same problem. We're seeing, at the sovereign level problems. We're seeing the sovereign debt crisis, the bursting sovereign debt bubble we've been talking about forever. It's playing out right now. And I think that's going to force them to pivot much sooner than most people think.
Okay, and I want to give you credit for having been talking about the risk of a global sovereign debt crisis for a long time. So I'm sure it's not the kind of thing you want to be right about, but I want to give you credit.
Yeah, well, thank you. Yeah, it's one of these things where you sort of look at the math and you just go, it is what it is.